Welcome to Lecture 5 in the Accounting Lecture Series. In this lecture, we look at inventory valuation and how it affects the balance sheet. This lecture is based on the book The Accounting Game, written by Darrell Mullis and Judith Orloff. This is what the ending balance sheet for week 2 looked like. To turn this into a beginning balance sheet for week 3, we have to roll up our earnings week to date and add them to our retained earnings. As you can see, we added the $10 in earnings week to date to the original $10 under retained earnings. The retained earnings category now has $20 in total. You go out to buy 50 more lemons, but the price has doubled to 40 cents per lemon due to a storm that destroyed a lot of the lemon crop. 50 lemons at 40 cents per lemon results in a cost of $20, which is charged to your account at the grocery store. What do we have to change to the balance sheet to reflect this purchase of 50 lemons for $20? You can pause the lecture video to think about it first. We added $20 under raw materials, bringing it up from $12 to $32. We also added $20 under accounts payable to reflect that you still have to pay $20 to the grocer. What do you think LIFO stands for? LIFO stands for last in, first out. Assume we will use the Lifo method to value inventory. What does LIFO stand for again? Last in, first out. The Lifo principle is illustrated in the drawing below. The idea is that when we value our inventory, we will assume that we will first use item number 4 in our production, even though it was added to the inventory last. Which other method to value inventory have you heard of? Fifo, which stands for first in, first out. As the image illustrates, this method of inventory valuation assumes that we will first use item number 1 in our production, which is also the item that was added to the inventory first. You want to make a new batch of 60 glasses of lemonade with 50 lemons and 5 pounds of sugar. The 5 pounds of sugar in inventory were purchased at 40 cents per pound. But you have 20 cent and 40 cent lemons. Which lemons are you going to take off inventory if you are using LIFO? If we use LIFO, we will assume for the purpose of inventory valuation that we will use the lemons that we added last first. These are the 40 cent lemons. So the cost of our goods manufactured is $20 for the 50 lemons at 40 cents per lemon and $2 for the 5 pounds of sugar at 40 cents per pound. That brings our cost of production using LIFO to $22. You made 60 glasses of lemonade. You used the Lifo method of inventory valuation. How should the fact that you produced a new batch of finished lemonade be reflected on the balance sheet? Please pause the lecture video to think about this yourself first. Earlier, we calculated that our cost of goods manufactured using LIFO was $22 for the new batch of 60 glasses. So we took $22 out of raw materials and added these $22 to finished goods. You have a great week. Sales for the week are 50 glasses in cash and 10 glasses on account. Remember, you charge 50 cents per glass. Your entire finished goods inventory is gone. You received $25 in cash and sold lemonade worth $5 on account. How should the balance sheet be adjusted? Please pause the lecture video to think about this yourself first. We adjusted finished goods from $22 to $0 since we sold our entire inventory. We added $25 to our cash. We added $5 to accounts receivable. The net change in the assets column is $8. This was calculated by taking $25 in cash plus $5 in accounts receivable minus $22 in cost of goods sold. We should add these $8 to our earnings week to date because this is the gross profit we made this week. Which lemons do you think we used to make lemonade? Please pause the lecture video to think about this. We used the 20-cent lemons, the ones that were older. You wouldn't really use the newer lemons first, would you? Lifo and Fifo are methods of valuing inventory, not of using inventory. So while the newer, more expensive lemons are taken off the books first, the older, cheaper ones are used in actuality.